REITs or real estate investment trusts have existed in the US for over 60 years and they are now owned by over 150 million Americans. But despite that, they remain some of the most misunderstood investments in the entire financial market. I've been covering REITs for over a decade now and I see daily through my interactions with different investors that REITs suffer many misconceptions. My theory is that this is because REITs are a bit of a weird category right in between stocks and real estate. But the issue here is that real estate investors don't really trust or understand the stock market, and then stock market investors don't really have a deep understanding about real estate. And so being a hybrid of the two has led to a lot of misconceptions, and in today's video I'm gonna try to correct some of the most important ones, hoping that it will help you improve your investment performance. Hey, this is Yussi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to talk to you about the 5 biggest misconceptions about REITs. Make sure to stick till the end of this video because I'm also going to discuss some of my favorite REIT investment opportunities in today's market. But before I get into it, could you please do me a huge favor and like this video? It'll really help me a lot to grow this channel. Thank you so much for all your support. So the first misconception here is that people appear to believe that REITs are just income investments. I can't tell you how many times I've seen people claim that you shouldn't invest in REITs because their dividend yields are low relative to interest rates. Just recently on one of my articles discussing realty income, I received a comment saying that there's no sense in owning realty income with a 6% dividend yield when I could just buy bonds with a 5.5% yield. What this shows you is that REITs are still seen as bond alternatives, as simply income investments in the eyes of many. But in reality, this is completely wrong. Just consider that REITs have generated roughly 13% average annual total returns over the past 20 years, outperforming even the S&P 500 and tech stocks. Less than half of these returns came from dividends and the other half came from growth and appreciation, and therefore it's simply wrong to state that REITs are income investments. Taking the example of realty income, which is one of the most popular REITs in the world, it today yields about 6%, but it has historically also been able to grow its cash flow per share as well as its dividend per share by about 5% per year. It's able to grow so steadily because its properties enjoy long-term leases with steady rent escalations, and it also retains about 30% of its cash flow to reinvest in more properties. And so doing simple math here, you have a 6% dividend yield, a 5% annual growth rate, you combine those two together and you get 11% average annual total returns. And so here you need to ask yourself, if you're long-term oriented, would you rather get a 5.5% yield from a money market fund, or would you prefer to invest in a REIT like realty income and earn a roughly 10% average annual total return from the yield and the growth? I think that the question is pretty simple to answer here. If you're long-term oriented, you don't need to care as much about the short-term volatility, and therefore you would much rather invest in REITs and other growth investments which will do a better job at compounding your long-term wealth. And I would add that in this example I didn't even include any repricing upside from some potential valuation multiple expansion. Today, REITs are priced at their lowest valuations in many years, with realty income trading at just 12 times FFO, but historically it's been priced at around 20 times FFO during most times. And so if you now think that interest rates might drop back down in the coming years, then you could add another 5 to 10% of annual upside from repricing. That could realistically get you closer to 15 to 20% average annual total return. So let me ask you once more, would you prefer to earn that, or would you prefer to invest in a money market fund earning you roughly 5% per year and also exposing you to significant reinvestment risk as well as inflation risk? It depends of course on what you're looking for, but my point here is simply that it's wrong to say that you shouldn't invest in REITs because their dividend yields are at around the same level as interest rates. In reality, REITs are total return investments that generate the bulk of their returns from growth and appreciation. Then the second misconception that I see all the time is that people claim that REITs are not tax efficient. They will typically assume this because REIT dividends are taxed as ordinary income, which is taxed at a higher rate. But this is very short-sighted because it ignores some very important factors that make REITs some of the most tax-efficient investments in the entire market. The first thing to consider here is that REITs are not paying any corporate income taxes, and so right off the bat, they have a head start. Then the second thing to consider is that REITs will typically retain a significant portion of their cash flow to reinvest in growth, and all of this cash flow that's retained at the REIT level isn't taxed because REITs don't pay any corporate income taxes. And so if now we have a REIT with, let's say, a 60% payout ratio, this means that 40% of the cash flow will be retained by the REIT and be fully tax deferred. Then the third factor to consider is that REITs will typically classify a portion of their dividend income as return of capital, which is also fully tax deferred. Then the fourth thing is that REIT dividends also enjoy a 20% deductible. Then fifth, REITs will typically invest in lower yielding, higher growth properties, which will generate the bulk of their returns from long-term appreciation. And then finally, as I mentioned earlier, REITs are today very heavily discounted, trading at some of the lowest valuation multiples ever. And so I think that in the coming years especially, we are likely to see most of the returns come from appreciation and not dividend income. And since appreciation is tax deferred, this makes REITs even more tax efficient. So the claim that REITs are not tax efficient simply because the dividend income is taxed as ordinary income is very short-sighted. So don't make the mistake of avoiding REITs that make large dividend payments, because in many cases, those are the REITs that are the most opportunistic in today's market. Before we go into the next misconception, quick plug for my service here. In case you want to access my entire real money REIT portfolio, you can join my REIT newsletter, High Yield Landlord, for a 2-week free trial. I'll put a link to it somewhere in the description of this video. The third misconception is that REITs will suffer heavily from rising interest rates. Just recently, I received a comment on one of my videos saying that REITs are going higher for longer. No one exactly knows for how long. This means hell for REITs. It's no-brainer to buy risk-free 5% treasuries or money market funds while waiting for the storm in REITs to ease. Again, this is nothing more than a misconception. No stock is immune to rising interest rates. All of them are impacted, including REITs. However, REITs are actually very resilient to the surge in interest rates because of two key reasons. First of all, REIT balance sheets are today the strongest they've ever been. The average LTV is today just around 30% and debt maturities are long and well staggered. This means that the leverage in the REIT sector is today historically low and the amount of debt that needs to be refinanced every year is very manageable. And then the second reason why REITs are resilient to the surge in interest rates is because they benefit from inflation. It's important here to remember that the recent surge in interest rates is a direct result from the high inflation that we experienced in the recent years. This has led to rapidly rising rents, and this explains why REIT cash flows and dividend payments have kept on rising over the past years, even as interest rates surged. So in short, you could argue here that the positive impact of inflation has a greater impact than the negative impact of rising interest rates. If you have a 30% LTV and a 10-year average debt maturity, this means that you will have less than 5% of your capital stock being refinanced every year at higher rates. However, the rent increases may impact about 100% of your assets at the same time, and so clearly the impact is going to be very significant. But don't take just my word for it. Some studies have actually been made on this topic, and they find that REITs tend to outperform and generate strong returns during times of rising interest rates. Again, this is expected because REITs have low leverage and they benefit from inflation. So the recent crash that we had in the REIT market is very much an anomaly from a historical perspective. I strongly believe that the market has here overreacted, especially when you consider that most other stocks have actually kept performing quite well, despite also being impacted by rising interest rates. Going forward, I think that REITs are especially attractive from this perspective because they are now heavily discounted relative to most other stocks, and this should increase their margin of safety in case interest rates keep on rising. The fourth misconception is that REITs are less rewarding than rental properties. I see people all the time claim that rentals are more rewarding because they benefit from leverage and you don't have to pay a manager. These are nothing more than misconceptions because REITs enjoy the exact same benefit of leverage. When you buy shares of a REIT, you're providing the equity to them, the equivalent of a down payment, and REITs then add some debt on top of that and you benefit from it in the same way as if you were buying a rental property with a bank's mortgage. The difference here is that you don't have to actually go out and take the mortgage yourself. The REIT will do it for you, you will benefit from it, and you don't have to give up your personal liability, so this debt is even better in the case of REITs. And then secondly, while it's true that REITs will pay generous salaries to their managers, here it's important to consider that REITs are really large vehicles that enjoy significant economies of scale, and as a result the management cost as a percentage of assets will still be a lot lower than for private properties. To take the example again of realty income, its management cost is today just around 30 basis points of its assets each year. That's very low, and this is because REITs like realty income owns thousands of properties, and so it leads to significant economies of scale. In comparison, if you own comparable properties in the private market, your management cost will probably be 3 to 4 times higher. But beyond that, REITs enjoy many other advantages that lead to higher total returns. They have the best talent working for them, they can develop their own properties, they can raise capital in the public capital market to reinvest it at a positive spread, growing the FFO per share at a faster pace than what they could achieve just in the private market. They can also enter other real estate related businesses such as brokerage, property management and so on, providing services for the investors to earn additional profits. They can also skip brokerage fees by going directly to the property owners. And there are many more advantages that REIT enjoy. If you want to learn more about this topic, I'll put a link to a video in the description of this video. But as a result of this, REITs tend to outperform private real estate by 2 to 4% per year on average, according to several studies. I'll put a few of them on the screen right now so you can see it for yourself. And then the fifth and final misconception here is that you should avoid REITs because they own offices, malls and hotels. I agree that those property sectors will likely face some pain in the coming years. However, what a lot of investors appear to ignore is that these properties only represent about 5% of the REIT sector. The vast majority of REITs today invest in much more defensive property sectors like single-family homes, apartment communities, cell towers, data centers, e-commerce warehouses, farmland, timberland, and so on. So just because a few specific property sectors are doing poorly doesn't mean that you should avoid REITs. In reality, these struggling property sectors are really just a minority, and the over 20 other property sectors are doing really well today. To give you an example here, I probably wouldn't buy an office REIT like Boston Properties because I think that will face significant headwinds in the coming years. However, just because offices are struggling doesn't mean that apartment communities in rapidly growing Sunbelt markets will face any pain. BSR REIT is a REIT that specializes in apartment communities in rapidly growing Texan markets like Dallas and Austin. Today, its rents are growing really rapidly as a lot of companies are relocating to Texas and bringing their jobs and employees with them. But despite that, it hasn't been immune to the recent crash in the REIT sector, and as a result, it's today priced at just around 60 cents on the dollar. So my point here is simply that just because two companies are structured as REITs, it doesn't mean that they have anything in common. So to recap here, REITs are not just income investments. REITs can be very tax efficient. REITs do not suffer nearly as much from rising interest rates as the market appears to believe. REITs are more rewarding than rental properties in most cases. And then finally, no, you shouldn't avoid REITs just because some office REITs and mall REITs are struggling today. Finally, if you want to access my entire real money REIT portfolio as well as my trade alerts in real time, feel free to join High Yield Landlord, my REIT newsletter for a 2-week free trial. I'll put a link to it somewhere in the description of this video. And otherwise, once more, if you could do me a huge favor and like this video, that really helped me a lot. Also subscribe to the channel to not miss any of our future investment opportunities, and otherwise see you at my next one. Thank you very much. Bye bye.